Hello and welcome to episode 200 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, we made it. It's 200.
It's going to say incredible. 200 episodes of a podcast. When we started, we didn't know whether it would work, did we, Andy? We just went and decided we should do a podcast. I think you rang me and said, I think you should do a podcast. And almost on the same day, I'd almost rang you and said, I'd like to do a podcast. And
the stars aligned for sure.
That was 4.5 years ago and 200 episodes later. And here we are. It's an amazing achievement to do 200 episodes about money. Not many podcasts have actually done that on any topic, let alone money. So, thank you to everybody who listens to the podcast. Of course, you, Andy, for all the work you do, because people don't realise that how this works is we do the podcast and then Andy goes away, takes our audio, puts it together, because we are in fact in 2 different locations, and then creates the podcast by editing it and then puts it all out. So if it wasn't for Andy, the podcast wouldn't exist. So there we go, Andy. Quick thank you to you.
Talking about that, which is very kind of you, but let's anyway, this isn't a backslappy episode. We're not those kind of people, but obviously the content is awesome and that's what drives the people to the site and to the podcast itself. Did you happen to see the review we had recently that tipped its hat to me as the main? Have you seen that?
No, I haven't.
It was Charlie. We actually met Charlie at the drinks, and he was being cute, and he was saying that basically if it wasn't for me, the podcast wouldn't be around, and Damien just, nips in each episode to put his 2 penneth in. I thought it was a very well written review, very tongue in cheek, and thanks for Charlie for doing that. And obviously, if anyone else wants to get on and give us a review, we'd love that. Sorry, Damien.
No, I was going to say, and thank you again to the people who came to the meetup the other week, because that's where we did much of the celebration of our 200th episode, and we will do another one again, as we keep promising. Maybe we'll do it at 250, Andy, because that's got a quite nice quarter of a century feel about it, doesn't it? So I think obviously this podcast will keep going and going and going. It's not going to end anytime soon.
And because there are 52 weeks in the year, that's going to be around about Christmas time again at the end of the year, next year. So that seems to me like that might work.
Yep, I think that will do. So anyway, Andy, what have you been up to this week? Anything exciting?
Well, I don't like to be boring. It's the same old thing. Busy working week as always. And actually it was so busy and I was so lost in a daze this week that somehow after 15 years of commuting into London, I managed to step on the wrong train home and I ended up 60 miles from my house, which must be well, I don't think it's quite a record. I'm sure there are people who have gone to the end of the line and gone up north and all sorts and down south. But it was interesting. It meant that I had to get 3 separate trains home, and it delayed me by 2.5 hours. So,
at what point now, Andy, did you realise that you were on the wrong train?
Embarrassingly, it was 45 minutes in when the train made its first stop. Now, I normally get a train. I did think to myself, I normally get a train that the first stop is after 25 minutes. And I did think after half an hour, we must be running a bit late here because we haven't yet hit Sevenoaks. And 20 minutes later, we still hadn't hit Sevenoaks. And anyway, the doors opened and I thought, finally we're here, Sevenoaks, here we are. And it said, welcome to Rochester. Okay, that's North Kent. That's a completely different area to where I was trying to get to. The problem is, here's my excuse. My train and that train that I got on have the same destination, but they go via 2 completely different routes. One goes through the South Kent and through the Weald, and the other one goes via North Kent. So I ended up on the wrong side of Kent, and unfortunately, because Kent is a big county, to get back to the other side of Kent, I either had to go back into London or across country. So I chose the cross country option, and got in about 10 o'clock at night.
And you don't even drink, Andy, so you couldn't even have had a beer on the way just to ease the time. Oh well, I mean that's quite impressive. My week's been actually more up and down. It's been, if you go on social media, follow us on social media. I had a photo shoot on Monday, which was incredible fun. You'll see me there being a tiger, posing and all that sort of stuff. It was just as you'd imagine it. A big room in, not me posing as a tiger, in a big room in the back end of a dodgy estate in London. But you don't realise that when you're in the studio and all this lighting on a chair all day for 7 hours doing poses and all sorts of things. And
was it literally 7 hours?
Yeah, I got there at 10. I got there at 10, and then we finished at 5 o'clock pretty much. Wow. And we have odd breaks, but it's because you have to do so many pictures and they have to get so many poses and lighting. And what you have to do is they want you in a as I do now, I'm talking to you, you can't see this on the podcast, but I wave my arms around, I get animated when I talk about money. And they wanted that aspect, so you have to sit there and talk about money or whatever to try and get that going, and they can take pictures. And then you do lots of different clothes changes, because it's all going to be for the new site, and obviously they don't know quite how each background will look, and etc, etc. So it was all day. It's good fun. Go and look on Instagram, because I've created a highlight on the stories which you can look at and shows you what my day was like. It's just as you'd imagine it. You've got a clothes round of clothes, you keep changing different clothes and sitting on stools, etc. So that was the beginning. By midweek, any thoughts of grandeur gone, as I had a hernia operation. So if I sound slightly subdued and less animated, it's because I'm obviously trying not to blow any stitches here. So I'm in my bedroom at this point. I'm almost basically in bed recording this podcast. So so we've gone from the highest to the lows in 1 week, and then we're obviously celebrating our 200th episode. But anyway, Andy, highs and lows. What's on the podcast this week, I think, is the big question. And obviously Brexit is going to feature in there somewhere. I couldn't ignore it, even though as much I want to try. So
if we're going to talk about Brexit, had we best make this a 2-hour special? Because I'm sure we can't cover it in the next 25 minutes, because it is crazy.
It is crazy. And what we're going to do is we're going to take a slightly different look at it. It's not about Brexit, it's not about politics, it's about investing. And it's because I was asked a question about what you should do in this scenario, about what you should do with your portfolio. And so I want to take it and make it obviously relevant to this current situation, but also really, like everything we do, we try and make it evergreen, so you can sit there and take what's going now, and if you listen to this in 2 years' time, you can apply it perhaps to the Brexit negotiations that will probably still be ongoing. I've got another question actually from somebody about investing and what I do with my money. Where would I put it? Which is again an interesting question. So I said I'd answer it. I don't mind that slightly personal element to it. And the last thing is about selling a house. Now, this isn't Brexit related, but it does have a slight Brexit angle to it. But it's about how long it takes you to sell your house at the moment, and perhaps a more effective way of doing it, because the length of time to sell your house is increasing in the current market.
Excellent. So we start with the investing piece that's got the slight sort of Brexit sort of theme running around.
Yeah, this came from a question I was sent that I received, and I'll just read it out, and then we'll veer off from the question. It said, what could be the best strategy if Theresa May's deal, her Brexit deal, gets scuppered and Corbyn gets into Downing Street? Would it be to invest into global shares or the FTSE 100 as the pound would weaken, or would it be to go to cash or buy gold? What's the best idea? So I wanted to delve into this question just because, generally speaking, it's got a lot of different angles to it. Now, Brexit this week has been complete chaos. It's unfolding as we speak. I mean, by the time we finish this podcast, Andy, there'll be a whole new wave of probably resignations, because as I'm doing this now, it's Friday. And so I've been in bed for pretty much a day and a half watching telly in Brexit, and I have no clue what's going on. I'm sure no one else has any clue what's going on. I don't think Theresa May really has a clue what's going on. So how do you invest for a scenario where you don't have a clue what's going on? A simple answer is you probably try not to do too much. Now, how would the markets react given different scenarios? Now, what's probably more insightful is how would I go about answering this question? The first thing I do is go back and try and find a time in recent history that has a lot of the characteristics and hallmarks of what's going on now. And the obvious time frame is the referendum vote that happened in 2016, because that was the point when everybody went, oh, and suddenly there was panic. And when there's panic, you get these sort of overextended moves in assets. So you, in a very short space of time, which can be days, you can suddenly see what would happen in extremes, if that makes sense. So if we really did have a no deal, what would likely be, you could extrapolate some of the things that happen in a very sort of panicked moment and say, well, maybe that would be, that movement would carry on, because obviously after the Brexit deal, some of those movements started to calm down. They started to almost revert to their mean. So let's go back to what happened after the referendum. The first thing that happened, if the assumption was that we were going to go crashing out of Europe, so the pound plummeted, because obviously the idea is that the UK economy would be hit, because given that the European Union is obviously a key trading partner, then our economy would suffer. Now, if you think about a currency is almost like a vote of confidence in a country and an economy. It's a very simplistic way to think about it, but that's, I think, a fair assumption. So, if there's a lack of confidence in the UK, what tends to happen is the pound will plummet. There are lots of reasons why it happens, but just think of it that way round. So the pound plummeted in value. We were at about $1.40 before that vote, and we ended up, over a period of time, ended up all the way down to about $1.20. We're now at around $1.30. When May came up with this deal recently, in this last week, it was almost certain that if it was kicked out or wasn't accepted, that the pound would fall, because you could go back to that 2016 period and see that it would. Because again, we're suddenly thinking, oh my God, we're going to go out with a no deal. That did actually happen. The pound fell 2 cents, which doesn't sound like a lot, but it's quite a lot. It ended up being about 2% in a day, which is a hell of a move in a currency world. And so if the deal got accepted, the opposite would happen. If it does get accepted, or we have some sort of clarity, then you could expect the pound to strengthen. And there are claims that we could see it go by 8%. We're talking it heading up towards $1.35, $1.37. The point of this is that it's all about certainty and uncertainty. If we have any form of certainty, and whatever that certainty may be, it may not necessarily be that we accept the deal. It may be some form of that there is actually a plan that's going to happen in order to try and get a better deal, and maybe not everybody's dropping like flies in the cabinet. If we start getting certainty of some kind, then it's likely the pound will strengthen, because markets hate uncertainty. They'd rather have some form of certainty, even if it isn't something they like, because then they feel that there's less panic. When there's panic, things start to move incredibly quickly. So we get some form of certainty, then the pound will strengthen. It's likely, if we get any kind of uncertainty, that the pound will continue to fall. So that will be Theresa May resigns. That means that we don't end up having some form of Brexit secretary for however long the Parliament rejects the deal. Whatever the uncertainty is, because there's going to be lots of this stuff going on, if Theresa May keeps plugging along, it could be the pound will start to gain some strength. Maybe not a lot, but we need some form of deal. So the key point is that over the very short term, the pound and the strength of the pound is probably going to have more impact on your portfolio than anything else. Because if you looked at your portfolio this week, on the Wednesday, you would have seen that probably, if you were quite well diversified and globally invested, you would have seen your portfolio fall in value, yet markets weren't necessarily plummeting, and it's because of the pound had strengthened. Whereas if you looked at your portfolio, say Thursday, you would have seen your portfolio jump by about 1%, maybe. Depends how you invested again, because the pound had plummeted. So it's that offset. So going back to that question, if it's something that's going to make the pound fall, then yeah, it should be good for the FTSE 100, because the FTSE 100, as we talked about before, lots of the companies in that index earn their money overseas, and it's normally dollar denominated. So that means that it actually is worth more pounds when it's converted back if the pound weakens against the dollar. So therefore, that's why you get a little uplift in the FTSE 100. It isn't like sort of lockstep. It doesn't definitely, if the pound weakens, the FTSE then rockets, but they do tend to move in opposite directions. But if the underlying reason is so terrible that the currency is falling, then it will drag down the FTSE 100. If you look at the small cap, so FTSE going down to the FTSE 250 and lower, they will tend to do badly regardless of what the currency is doing, but they will do badly because of the whole Brexit theme, because it looks like the UK economy is going to implode. The one thing that will probably do badly, and has done this week, are bank shares, because the deal will likely mean that the City of London will be weakened, and then the access they have to European markets. If you look at this week, bank shares got hammered. They were falling almost up to 10% in a single day, so that will likely continue to happen. If you go back to the referendum date, it was a similar move for bank shares around when the referendum result was announced, so you could see something like that happen again. If you want to end up playing the currency, because like I say, it's going to be a lot about what happens to the pound, it almost means that if you think the pound's going to weaken because this is all going to go into a complete car crash, there is no deal, there's going to be a lot of unrest in the government, or perhaps a general election, then holding cash is actually going to be to your detriment, because there is no kicker. If you've got a pound, if you're holding quite a heavy weight of cash in your portfolio, then if the value of the pound falls, it makes no difference to you. Now, that was the position that my portfolio is currently in my 50k portfolio with 80-20 investors, so I didn't get as much of a kick on that section. If you held any asset that was denominated in overseas currencies, particularly the dollar, you'd make money. And even if that asset is probably falling in value itself, so US shares have been falling this week, but the pound has been falling faster. So actually, when you look at how much your US equity fund is worth, it's probably gone up in value. So going back to the gentleman's question, it actually doesn't matter what asset it really is. If the currency is going to have some wild moves, it's probably going to have such a big impact if it keeps falling that you won't notice what the underlying asset is doing. But that doesn't mean you just go and hold any asset overseas, because obviously there's risk involved. Do you buy gold? Now, gold is an incredibly volatile asset in itself. Go and find the gold price on your phone, Google it, and see how much that line wiggles up and down. It actually is a very volatile asset, and it doesn't necessarily de-risk a portfolio. People buy it in periods of panic, but it normally does well when it's systemic, so it's like a financial crisis, not just because of Brexit. I mean, that's one thing going on in the world. It's quite a big thing, but it's just one thing. So gold won't necessarily react in an extreme way, like rally very strongly just because of Brexit. We haven't seen that yet. It would be if there's a financial crisis. Holding gold is only a hedge against some form of volatility if you only hold about 5 to 10% in a portfolio. Any more than that exaggerates and actually increases volatility, because it's a very volatile asset in itself. As Warren Buffett once said, when you buy gold, you're really buying it because it doesn't do anything. It's an inert element. It doesn't really have many uses in industry. And so you're buying it thinking that somebody else is going to be more scared than you in the future and panic and buy it. So in itself, I wouldn't necessarily particularly buy gold. So the overriding thing is we don't really know what's going to happen with Brexit. We don't know what's going to happen with the currency, but it's likely that it's going to have the biggest impact on your portfolio in the short term, some big moves up and down. Trying to second guess it is a mug's game, and you're likely to get caught on the wrong side of a trade. So any particular day you could expect the pound to jump up 1, 2, 3% either way, depending on news headlines. And therefore, I don't think it's a good idea to try and trade it. And making changes to your portfolio right now is going to be a bit of a chance, because there's a very good chance that the pound will move wildly in the next sort of, weeks or whatever. So bear that in mind. There's no great strategy at the moment to Brexit-proof your portfolio. Probably one of the best things is to sit on your hands and do nothing until we know what is going on. Because like I said, the market likes certainty and not uncertainty. And during periods of uncertainty, that's when you get lots of unpredictability. And that's not a good time to try and invest or make money. That's more like going down the lines of speculating. And we're in a very uncertain environment. Before we move on, Andy, I just wanted to quickly mention 80-20 Investor. Now, 80-20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80-20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80-20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80-20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
So Damien, what I love about you is you're not afraid to tell it how it is. You're one of the only people I know out there that publicly displays your investment portfolio and sort of, gives a running commentary on that. And you've had a question this week where someone's asked you pretty directly, really, what is it that you would invest in? So what have we got?
Yeah, what the question related to was my £50,000 portfolio that I run on 80-20, and they said, well, where do you hold the rest of your money? Where is it? And how do you invest it? Is it split between all asset groups, cash, whatever? And they didn't know whether they were being too personal. It was quite a personal question, to be honest with you. But, as you know, I like to be as candid and open as I can be. And while respecting my own family's privacy, of course. But I don't mind answering this. And it's because it's quite a simple question. Money to the Masses is a business that I'm growing, obviously. It now employs me and other people. So the 50k portfolio that I run is effectively the assets that I have, that I'm investing. I hold some other bits and pieces that are basically cash and not much else. And everything else that I have is growing a business. So it isn't a cheat of an answer. That is just the reality. And it gives you insight into the way I think about finance as well. That it's great to want to invest and obviously build your pension pot. But there is the obvious reality that sometimes you can't do everything. And if you're trying to build a business or you're trying to buy a house, there are sometimes things have to give. And you sometimes can't be going investing for tomorrow if you can't afford today. So the short answer is I would invest as I do in my 50k portfolio. But I want to add another element to that. And again, this gives a bit of insight into how I would perhaps change things if it wasn't in the public domain. With the 50k portfolio, I have to be conscious that people may copy it. And so therefore I have to make it incredibly balanced. I have to make sure that it's got a good spread of risk in there. So low risk assets, high risk assets. If I was investing for myself personally with a very long time frame, I would take more risk than I do in that portfolio. And so I'm keeping it balanced because I know that for most people that is what is the best thing to do. So some people who are looking to invest, they can choose to take more risk or they can choose to take less risk. That's the wonders of what 80-20 investor was designed to do. But I'm conscious that I have to therefore be balanced. So I tend to stick between 50 and 60% in equities. For myself, I might take more risk than that because I'd be more comfortable with doing that because I appreciate the upsides and the downsides. So that's just giving people an insight. Another point I want to just throw out there is, would I only exclusively do 80-20 investor? I think the reality is obviously it's something that I believe in passionately and I would do it, but I'd also be open to other strategies of investing money and maybe having elements that are, say, passive investing, that is just index tracking. There's nothing wrong with doing that because the thing is, in different market conditions, what happens is different types of investment strategies work better. So momentum has worked wonderfully in the last, say, 5 to 10 years because once the market turned and we've been in this bull run, it's been very good. But there'll be periods where it won't work so well because that's just the realities of the market. So if the market is to tumble 20% in a day, then obviously momentum is going to go down with it. But that's going to be the same with an index tracker. But there's nothing wrong with doing different types of investment strategies. And on that, it was quite interesting to note that Warren Buffett bought a large stake in a particular company this week, which when you look at that company, it is actually the 6th largest holding in a momentum-based ETF that's out there. So the world's greatest value investor, indeed, could be argued, is investing in a momentum fashion right now. And what that just illustrates that these things overlap. So value and momentum can overlap at some point. So I think I've answered that question. At the moment, I would invest my money as I would do in the 50k portfolio, and more money, just amplify the positions in the same proportions. But obviously, I haven't got all that money to invest because it's in money to the masses. So I'm trying to grow that business. Before we go on, actually, Andy, one of the things I just thought about, going back to the earlier piece, bonds and gilts, that was something I should have mentioned on the Brexit piece, which has sprung to mind, is that, interestingly, gilts did quite well during this phase of all that uncertainty. And that's because, obviously, people start worrying that the economy's not going to do so well. And the Bank of England, therefore, might have to start doing QE again and cut interest rates. And that will be positive for gilts, which are the loans to the UK government, which you can invest in. So I just throw that in as an aside because it's almost like in times of uncertainty, people head towards safety as well. So I wanted to throw that one in. Anyway, on to the next one. Talking about investing, Andy. Property. That's the next piece.
Yeah, the bit about selling your house, the length it takes, it's becoming a tiring, longer process. What's going on?
Right. Property is one of those things that people are obviously passionate about or they are averse to. It's funny, I've been reading quite a lot in the newspapers lately. I always see these stories of these individuals who tend to be celebrities and they're really passionate about buying property, and it's their pension and all those kind of things. And people who listen to this podcast know I'm a more open-minded. I'm not a massive fan of just putting all your money in property, but I'm not actually averse to the idea of investing in property either. I'm not a champion of pensions or anything like that. I sort of digress slightly there, linking it to the earlier piece. But if you want to sell your house at the moment, property is having a tough cycle. It's taking longer to sell your house, and that's reflective of the fact that it's not a market for sellers, and so therefore house prices are starting to struggle. So if you invest in property, you'll probably be more than aware of this when you look at the valuation of your house. But if you just your home and you're thinking of moving, then the property market is starting to struggle. And I can't remember if I talked about in a previous podcast, but I had a good friend who works in the industry and sells houses, and he was moaning about the fact he's struggling to sell houses now because of Brexit. And just to quickly add it, if you haven't heard this before, but basically where he used to sell, or his offices used to sell, they say, a dozen houses in a month, they're barely shifting one. And it's because people were worried about Brexit. There was obviously Mark Carney saying house prices could fall 30% if we had a no deal. He didn't actually say that, but he was misquoted, but that was enough to get people scared. So the market's slowing down, and apparently on average it's taken 102 days now to sell a house. So to go from putting it on to getting an offer onto it. So, I mean, that's quite a long time. That's heading towards 3 months. And I don't think that's going to change. And the way that is, I think, till we get more certainty, because like I was talking about earlier, certainty and uncertainty, it's the same with the housing market and people who buy houses and sell houses. The first-time buyers are nervous. People are nervous about moving and scaling up because they don't know what's going to happen with things, particularly Brexit, what's going to happen to their jobs. So therefore, that means that people stop buying and selling houses. If they can sit tight, they'd rather do that. If they could convert their loft rather than buying a bigger house and take on a bigger mortgage, they'll probably do that. So, again, it's this certainty and uncertainty that's impacting it. But what's interesting is in a period like this, and you still want to move, there are plenty of people who need to move because it may be because of schools or jobs, then is it better to go with a online agent, so the likes of Purple Bricks, because I've heard some fantastic things about them. Obviously, they can be a lot cheaper than a high street agent. Or do you go with a high street agent, a guy who's going to come round, or a lady who's going to come round and value your house and do their utmost to sell it for you, rather than you having to do all the work with an online agent? Saying that, when I said a guy, funnily, one of the insights I got from the industry before, for somebody who used to work very senior in the industry, that women were actually the better estate agents in his experience, selling houses. Some of the best people he had working for him who sold houses were women, which is obviously very interesting. I think it's the empathy. Yeah. And do
you know what, Damien? I mean, that doesn't really surprise me. You know, it really doesn't.
No, and when once you said it, it made a lot of sense. And I remember our own journey of buying a house. It was very much driven by my wife. The interesting thing is, though, is the conversion rate. It's the cost is important, but it's the conversion rate, because are you going to ever sell your house with an online agent? So you pay out them some money up front. Are you actually going to ever sell your house? And in a market where it's very negative and it's not very great for selling your house, is it even worth trying to do it yourself on the cheap? And the stats suggest that a high street agent will be probably better at selling your house in this environment, because the conversion rate of a high street agent, I'm told, is around 60%. So we're going from properties listed to being offered to potentially, I mean, obviously that's got to go through all the legal stuff to actually be sold, but actually somebody puts an offer in on the house. Somebody did some research on all the online agents and worked out conversion rates. And now, I mean, this is their research, I can't confirm any of this, so I'm going to just run through them. Doorsteps is one agent, that's an online one, 28% conversion from listed to offer. Yopa, 35%. Purple Bricks, 43%, which I thought was very good actually. eMove, 32% conversion from listed to under offer, and Tepelo is 33%, and House Simple has a 30% conversion rate. So lower than the high street. I'm sure if you went through some of the high street estate agents, you'd probably find some wide-ranging statistics. But the only thing I suppose in the high street agents' armoury is that they would be driven to try and sell your house. But what they will do, in fact, is just drive down the price that you sell it at. So they will just get you to put it lower. And I know this off the record, that they're all doing this in the background from above high above in the sort of boardrooms are putting pressure on all the companies to say, look, all these houses on our books, we've got to shift them. We need to generate revenue, fix the fees, and just get them out the door, which means basically...
And this is the high street ones you're talking about.
This is the high street, yeah. And so basically they're telling people to cut the agents to go out there and say to people, you need to lower your house price.
I had a friend who recently had a really poor experience with a high street agent just purely because of exactly that tactic. You would think that they would go in there and say how beautiful the house was and how amazing it is and how much they'd like to sell it. In fact, what they're doing is they're setting the client's expectations really quite low and setting them up for a fall almost giving themselves that little bit of wiggle room so that they can knock them down because they know they've got more chance of selling it if they can get in there with a lower price, which is kind of reversing the whole, in your mind you would think that they would be giving you a high price because then you feel fantastic, but it's almost the other way around at the moment.
Yeah, and I think the message is that, when I was talking about this on Twitter and I got some really good feedback about some of the online agents, and I think what you need to do is just take a best of both worlds in some way. You could do that and put a realistic house price for your house that's set, and it will shift, and you could do it yourself. So take that information as you will, do what you want with it. The conversion rates are as they are, but the high street tactics, there's nothing to say you couldn't use some of those if you sold it yourself. I'm in the middle. I'm slightly indifferent. If I was selling my house, I would probably be slightly inclined to use an agent that I knew in the local area. Maybe not. We'd have to see. My neighbour's trying to sell their house, so I'll see how they do, and they're using one of the offline agents. So I'll keep you posted. I hope they don't. I hope they don't listen to this podcast. By the way, I'm sure they don't. They do follow me on Twitter.
It's always good when a neighbour sells their house because it gives you a sort of bit of insight as to what your house might be worth. Obviously, houses are very different. You've maybe had some work done, but it does give you that little bit of a benchmark. At the moment, it may be worth X. It's kind of quite interesting.
Yeah. Anyway, Andy, that's it for this week. I think we're done. Hopefully, we'll be back with 201 next week, and I'll be a little bit more mobile.
Fantastic. Enjoyed it this week. Do get in touch with Damien if you would like to do so in the usual ways. So get onto Twitter @money2themasses. Damien, Instagram's a big thing for you right now. I'm not very good at reading out the Instagram contact details, mainly because I'm not really all over Instagram. I'm going to be in the coming weeks, mark my words, because it's where it's going. How do people actually find you on Instagram? Do they just search, or have you got a different...
Yeah, Money to the Masses. So just actually no number 2 or anything. Money to the Masses is the handle, the username. So just search for it, and I'm all over it. I'm doing stories and everything. We're very much into Instagram at the moment. So behind the scenes, you'll see me talking to camera all the time about money, you name it. It's on there.
And I'm fully aware that what I've just done there is I've outed myself as being a complete Luddite. I'm not. I'm generally all over the socials. It's just that one social that
Andy,
I will get on it.
Andy, you've already explained you struggle with train timetables. I'd already assumed that social media could be one step too far.
I can just see people listening to this podcast shaking their head thinking, who is this guy? Right, okay, we'll see you next week.
See you next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.